Welcome to Get Rich Education. I'm your host, Keith Weinhold. The rich are getting richer and the poor are getting poorer. I can't think of any one time in my life where that's been happening more than it has been right now. I'll tell you why and what you need to do to get on the right side of that. What is going on in the real estate market and what are the real estate economics that matter? Then a discussion about inflation today on Get Rich Education. Fortunately for you, Congress has made it possible to get up to $200,000 out of your current 401k or TSP to invest in real estate or your own business, and that's even if you're still working. The thing is, you can get all this money tax-free. The EQRP is your secret weapon. With the CARES Act expiring soon, the EQRP company helps you unleash your retirement funds now. Learn more and text message QRP in all capital letters to 72,000.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Hey, you're inside GRE from Manila, Philippines to Managua, Nicaragua, and across 188 nations worldwide. I'm Keith Weinhold. This is Get Rich Education. The rich are getting richer, the poor are getting poorer, and I can't think of any one time in my life where that's been happening more than it has been right now. Because Americans living paycheck to paycheck might now be paycheck less, some of them are laid off because of the pandemic, and now they're concerned that there's no national eviction ban. That's right. In most states, non-paying tenants can be evicted at this time. Now, you've got to check your local law. Well, when is Congress going to do something to relieve those that the pandemic has left unemployed? Well, they don't even reconvene until after Labor Day. Some people are wondering, where is the CARES Act 2? Where are those updated forbearance options, eviction moratorium, the Paycheck Protection Program, and the $1,200 stimulus checks, and the stepped-up weekly unemployment compensation? In fact, Richmond Fed President Thomas Barkin had a good metaphor. He said, months ago, when we did the first stimulus, we thought the economy faced a pothole, and the stimulus put a plate over it so we could navigate. Now, escalation of the virus may be making that pothole into a sinkhole and creating a need for a longer plate. That's the end of what the Fed president said. Now, look, I think there's a lot to be said for just letting the free market do its job in normal times, but it's a little hard to be in this laissez-faire Austrian economic school of thought when a lot of people could be suffering. So that you know what I'm talking about, laissez-faire or laissez-faire, that basically means no government intervention into the free market. And meanwhile, the rich are binging off Federal Reserve policy and liquidity injections that keep mortgage interest rates at historic lows and the S&P 500 at an all-time high. Mortgage rates recently dipped below 3%, which is just amazing. You don't even have to be that rich in order to benefit, because if you've got substantial exposure to the real estate market or even the stock market, chances are those assets are doing all right. One thing that you need to keep in mind as an investor is that when the Fed puts rates on the floor, of course it affects more than just mortgage rates. It affects other rates too, like savings account rates. Just look at bank savings accounts. Even if you're in one of those online banks that give better yields than traditional brick and mortar banks, we're talking about online first banks like Ally Bank and Popular Bank. Well, they were paying 2.5 percentage points on savings accounts not all that long ago. Even those banks are now down to about 0.75%, probably less than the real rate of inflation then. So because savers get punished worse than ever right now, what that does is it in turn forces more people into things like real estate because they're all in search of that yield. Even retirees can't rely on the paltry income from 0.75% yield, so they have to go to the markets to chase yields, sometimes kind of unwillingly. Well, when all these people that got negative real yields on savings accounts and CDs, and they say they're just not going to stand for it anymore, well, it forces more demand and more money into markets, and then consequently it floats the price of everything up. That is what's going on now. Now, personally, I don't really like this deepening canyon between the rich and the poor, but I do know which side I would rather be on. Besides the investment properties, a lot of people, they want to move and shake up their living situation like never before, their primary residence, and filter their new home buying criteria on pandemic ways of life. Bidding wars continue to be rampant for single-family homes. And how rampant are they? Well, Zillow just reported their highest daily active user count ever, all time in history. Now, though property data can move even slower than your last 1031 exchange did, real estate economist Darren Bloomquist, he just compiled these year-over-year price changes through Q2, and you've heard Darren Bloomquist on the show here. He broke it down this way. City real estate is up 4%. Again, this is all year over year through the second quarter. Town real estate is also up 4%. Suburban is up 5%, and rural up 11%. And the two sources are Atom Data Solutions and the U.S. Census Bureau there. So rural is appreciating the best. City and town is appreciating the least. And with time, I expect urban areas and apartments to slump. Of course, urban areas and apartments are synonymous with each other. They kind of go together. Yeah, in the pandemic, living in a lot of these large apartment buildings has become about as fashionable as jazzercise in the Atkins diet. Of course, at GRE, we've long focused on rental single-family homes. We've talked a little about apartments, and you also know that I started out with a fourplex and got my start in real estate that way. Just last week, NAR chief economist Lawrence Yun noted that there's an oversupply of apartment buildings, especially in city centers, given the evident recent shift in consumer preference for single-family homes in the suburbs. Lawrence Yun continued, apartment rent growth could therefore be tough going ahead. The rise of single-family units is welcome, as overall inventory of homes for sale are down 19% from 1 year ago, and there is intense buyer competition in the market as a result. That's the end of what Lawrence Yun said. So as long as your tenant can pay the rent, this is welcome news for your existing rental single-family homes, like the ones that you've acquired through GREturnkey.com. It puts upward pressure on the price because those valuations are based on comparable properties. So congratulations there. The appetite for real assets, especially desirable rental single-family homes, which is now propelled by low inventory and low interest rates, has put you in pretty good shape if you've acted. But of course, be mindful, the COVID pandemic, it's still not over. We don't really know how all of this is going to turn out. And remember too, even when a vaccine is developed, it's probably going to take at least a few months to distribute it. In my own portfolio, all of my single-family rental homes are occupied 100%, but my apartment building vacancies are unusually high right now. When we talk about apartment buildings and things like office buildings as well, and some retail, Axios recently reported about how residents and workers are experiencing what they call elevator anxiety. I'll put that article in the show notes for you. An elevator, that is one of the most physically uncomfortable and awkward places to be in the pandemic. If you're wondering about how that real estate physically looks, we're generally talking about buildings that are 4 or more stories in height. In fact, the ADA, the Americans with Disabilities Act, that stipulates that properties with 4 or more stories generally are going to need to have an elevator. And I'll tell you, if apartment buildings are as unfashionable as the Atkins diet these days, then being inside an elevator is about as hip as Jane Fonda workout videos or Nordic track or sweating to the oldies with Richard Simmons.
1, 2, 3, 4. Now double here. That's it. You're doing fantastic.
Oh, jeez. Did that really just happen? I guess it did. So while we're all processing that, getting back to real estate here. Now, Fannie Mae and Freddie Mac recently said that they will start charging a 0.5%, what they call an adverse market fee on all refinances, including both cash out and non-cash out refis. They're trying to put that new fee into effect for next month. What a drag that would be. So therefore, for every $200,000 that you refinance, you'd have to pay an additional $1,000 fee, or maybe your lender would pay for it. What Freddie Mac said is, as a result of risk management and loss forecasting precipitated by COVID-19 related economic and market uncertainty, we are introducing a new, what they call market condition credit fee in price. So Freddie sent in their notice to lenders. Wouldn't that be an annoying fee? Well, what happened is almost immediately there was a blowback. The National Association of Mortgage Bankers struck back. They launched a campaign to reverse that newly announced 0.5% refinancing fee. We'll see where that goes. Now, things are really good for home builders these days. In fact, an index measuring home builder sentiment matched its highest level ever just last week. And why is that? Well, it's actually pretty simple. There is a healthy amount of demand from buyers and not enough homes to meet it. Also, the 30-year fixed mortgage bottomed out at 2.88% earlier this month. The lowest point on record, the lowest point in Freddie Mac history since they've been tracking it in 1971. And those low borrowing rates are boosting home buyers' appetites. Obviously, that's good for home builders. Elsewhere, there really are a few recent stories that I would call de facto microcosms, reflections of this appetite for a work from home arrangement. Sometimes you can even think of it as a work from anywhere arrangement, as RV living has become more popular, and this less dense housing. For example, it's really telling to look at what the outdoor clothing and gear company REI just did. And do you like REI? I personally like shopping there. Even if you aren't into outdoor stuff, you can always find a cool water bottle or something at REI. It's just nice to shop there. Well, they announced plans to sell the lavish corporate campus that they had just finished building near Seattle. Yeah, REI executives concluded that employees were able to collaborate remotely better than the company originally thought, so a massive physical headquarters just wasn't worth the cost anymore. So REI is turning around and selling what they had just built. That tells you a lot about what's going on in commercial real estate. Other real estate segments falling out of favor are those high-density places like you might expect, led by New York City and San Francisco. StreetEasy reported that Manhattan home values dropped 4.2% since last year, and homes are lingering on the market 2 months longer than they had just last year. San Francisco list prices are down 5% annually, while inventory in San Fran is up 96%. Yeah, a near doubling of available inventory there. New York City and San Francisco were already the most expensive housing markets in the country before the pandemic, and life under lockdown has given people that nudge that they had been considering for years. And then single-family homes in outlying areas, they are the real beneficiaries here. There have been a number of notable milestones. Colorado single-family home sales rose 21% July over July. The median price statewide in Colorado is now $444,000. And just looking at Denver itself, Denver just broke the $600,000 mark for the first time ever. Not a coastal place, an inland city here. So a few months into the pandemic, we are getting this clearer sense of who the winners and losers are, and a lot of them are what we expected. If I had to slim it down to just a 3-word answer for you on why the rich are getting richer, those 3 words are federal monetary stimulus, and the stimulus is disproportionately benefiting asset owners. Well, the pandemic hasn't affected some real estate investors at all. Others feel more reliant on that next government stimulus program to give their tenants the wherewithal to pay the rent. Well, if you, as an investor, if you want to have the majority of your rent income payment guaranteed to be made by the government to you over the long term without any pauses or lapses in that, well, that's exactly what landlords of tenants with this HUD-funded Section 8 housing have enjoyed for decades. You have guaranteed rent income. I think I remember that I had a turnkey provider that specializes in Section 8 housing here on the show on Get Rich Education, episode 297. So just 10 shows ago, which was 10 weeks ago. Like any investment, Section 8 housing is probably best viewed through a prism of pros and cons. Section 8 is not for everybody. Some love it, some don't. But this provider manages the Section 8 administration for you. They've got a great relationship with the housing authority, and that's something that most landlords of this government-subsidized housing have simply never had. Guaranteed rent income has a nicer ring to it than it did just a year ago. You can get the provider report and learn more at getricheducation.com/Section 8. That's our Richmond, Virginia provider, by the way. In fact, CNBC named Virginia as the most business-friendly state in the entire nation. I'm Keith Weinhold, and I'm coming back to talk with you about inflation and quite a bit more. Again, learn more at getricheducation.com/Section 8 on guaranteed rent income. This is Get Rich Education. Property investors can get killed with maintenance costs. That's less likely when you buy brand new construction. Let me tell you about JWB Real Estate Capital in bustling Jacksonville, Florida. They pioneered the build-to-rent model where you can invest in new construction, turnkey rental property. That's why JWB was featured on the front page of the Wall Street Journal. To learn more and see inventory, start now at newconstructionturnkey.com. The people that our listeners can't stop talking about are Ridge Lending Group and MLS 42056. They provided you with more loans than anyone. It's where I got my last few loans, and they finance single-family income property up to 4plexes. They're the #1 lender for both beginners and veterans. Start your pre-qualification, chat with President Chaley Ridge personally, and you'll end up with your custom plan for expanding your cash flowing portfolio. Start at ridgelendinggroup.com.
This is the Real Wealth Network's Kathy Fettke, and you are listening to the always valuable Get Rich Education with Keith Weinhold.
Hey, you're back inside Get Rich Education. I'm your host, Keith Weinhold. Both the pandemic-driven CARES Act and then whatever other monetary stimulus acts that follow, they are injections of trillions of dollars into the economy. In fact, it's now driven our national debt to nearly $27 trillion. It's going to reach that mark really soon. Of course, this has the effect of money printing. It's not literal money printing. The more you learn about it, it's often U.S. government bond issuance. A bond really just means that the government issues an IOU that someone else like China buys. That's what a bond is. Those are some of the semantics behind what you can really more closely think of as currency creation rather than money printing. Will all of this result in inflation? That is the big question for macroeconomists. Well, longer term, many think yes, and short term, no, because we're still in a low demand environment. Of course, as a real estate investor, you want inflation. You might have seen on the Get Rich Education YouTube channel, where I have visually mapped out how you win what I call the inflation triple crown. In fact, if you just Google the 3 words inflation triple crown, you can probably see me as the first hit on Google, and you can watch me doing the whiteboard video. That's a great way to learn. As you'll remember, real estate investors win the inflation triple crown because inflation provides you with, number 1, asset price inflation, number 2, debt debasement, and number 3, cash flow enhancement. And that all works terrifically when you have a loan on that property, when you're leveraged. And there are more signs of inflation out there in the economy right now than we've seen in the recent past, although I expect inflation to still be pretty mild as long as we're in this pandemic-driven low demand environment. The Consumer Price Index rose 0.6% just last month. That beat the 0.2 expectation that economists had had. Food prices are up substantially. And then a really big input into homebuilder pricing, and therefore the future value of homes, is lumber. And lumber prices have been soaring higher. Treasury Secretary Steve Mnuchin has said that the administration is unfazed with these historically obscenely high levels of government spending, and he said that is thanks to the nation's very low interest rates. So you see, the Fed is less concerned about their mounting debt when the interest rate that they pay on their debt is low, and that's a lot like you're less concerned about your debt when your interest rate is low. You might be looking to take on more debt now. Of course, you've got a better deal on your real estate debt than the federal government does because the federal government does not have tenants to service their debt for them like you do in an occupied rental property. Could America reach a stagflationary state like it did in the 1970s? We haven't discussed the economic phenomena of stagflation before. Do you know what that is? Stagflation is a stagnant economy with inflation. That's what it means. Okay, usually a more stagnant economy like we're in now is characterized by low inflation due to that lower demand, not running up the prices of consumer goods and household staples. But again, stagflation means that there's a stagnant economy with high inflation. Could that happen this decade? To help reinforce your learning here, let's listen to the audio from this explainer video from 1 Minute Economics about stagflation. This is less than a minute and a half in length.
When the economy is growing and the unemployment rate is low, inflation tends to appear for the simple reason that you have more money chasing goods. The same way, you usually don't have high inflation when the economy isn't doing well and unemployment is high. Stagflation represents an exception. During the 70s and early 80s, countries such as the United States found themselves in a peculiar predicament. 1. Their economy was stagnating. 2. Their unemployment rate was quite high. 3. They had high inflation. This strange phenomenon ended up being called stagflation. The 2 most plausible scenarios which explain why it appeared are 1. Dramatic oil price increases made production costs higher and companies didn't manage to adapt properly. Due to the 1973 OPEC embargo and the 1979 Iran Revolution, oil prices more than doubled within months. 2. Milton Friedman believed poor monetary policy was to blame and considered that central banks weren't aggressive enough in their effort to fight inflation. As of 1979, Paul Volcker became the chairman of the Federal Reserve and implemented Friedman's aggressive anti-inflation policies. Also, there were no more dramatic oil price increases, and on the contrary, oil prices went down a lot. For these 2 reasons, and perhaps others, the stagflation problem came to an end. But this much is certain. Stagflation made it crystal clear that economic models are not flawless. In other words, all of us should understand that economists can definitely be taken by surprise.
Yes, well, if we get stagflation, meaning, again, a stagnant economy with high inflation, see, I don't know that we'd have another Fed chief like Paul Volcker who, about 40 years ago, brazenly raised interest rates so aggressively to combat inflation that mortgage rates were 18% 40 years ago. I don't know that anyone would prevent inflation from running away again like he did. But again, that's stagflation. Now, I know you might be thinking, Maybe you've thought that all of the Fed currency creation that pulled us out of 2009's Great Recession, you're like, well, that didn't produce high inflation, so why would it be any different this time with all these current cycles of massive dollar creation once again? And that would be a valid thing for you to think. At least based on the official numbers, we've only had about a 2% monetary inflation in recent years. We'll see, though high inflation was not the overall result 10 years ago, it might have actually been created and you just never knew it. So here's what I mean. Say that the expansion of this globalization and all this tech advancement, it really meant that we had negative 5% inflation. Another way to say that is what if we would have had 5 points of deflation if there weren't any excess dollar creation? But yet all of the dollar creation after the Great Recession caused 7% inflation. Well, then 5 points of deflation offset by 7% inflation resulted in that 2% inflation. Think about it that way. Maybe something like that is what really happened, and that is why all of today's currency creation could result in high inflation. We don't know that it will, but that's just one reason why it could. Now, overall, to pull back and look at the state of housing in this pandemic-driven recession, housing has been and continues to be substantially better off in this recession than it was in the 2008 recession. And that event 12 years ago, see, that had a housing collapse as a driver. People left their keys and walked away from their homes back then. Well, now, oppositely, we've got bidding wars for housing. And I do want to temper that with a reminder that the pandemic is not over yet and things could still take an unforeseen turn. And the bad part about this recession compared to the last one is we do have higher unemployment now, and that matters. And now the reasons that real estate is better off in this recession compared to the last one is the old economics 101 of supply and demand. Housing demand vastly exceeds supply. That was the opposite last recession. Responsible lending has prevailed leading up to this recession. Again, that was the opposite of last time. We've got low mortgage rates now, lower than they've ever been. And another thing to consider is we did not have any bubbly price run-up before this recession, unlike what happened in the 2008 Great Recession when some markets gained 30% per year leading up to that. So they are the key differences between last recession and this recession, especially with respect to housing. Some really substantial, fundamental economic differences there. Coming up on a future episode here, we are primarily a show about how buy and hold residential investment property produces wealth for you and how to avoid mistakes around that. But so many people today are reevaluating their primary residence situation that I'm going to go deep on should you rent your home or should you own your home on an upcoming show. There is some counterintuition and paradox here. I'm going to give you a new twist on the fact that if you pay rent, that is not the same as throwing money away. And also, some people seem to think that home ownership is like renting, except you get to keep it. Well, that notion is false, and that notion has caused millions of people to buy their own primary residences that they later regret. In fact, do you think that your primary residence is an investment? Do you consider it an investment? Well, in almost every case, it is a poor financial investment, but it could be a good lifestyle investment. So should you rent your home or own your home that you live in? That's coming up on a future show. Well, regardless of your living situation, pandemic-driven unemployment might have made you realize that you do need to establish a durable, long-term second source of income if you don't already have one. Even if you aren't losing your job, circumstances have probably hit pretty close to home for a lot of people. You can either let other people make money off of your money, like the bank paying people less than 1% on their savings, or you can make money ethically off other people's money, like borrowing at a 5% mortgage to invest at 11% or 15%, or hopefully a lot more than 11 or 15% with the up to 5 profit centers that investment real estate has. Real estate is that instrument of arbitrage. As they say, you can either teach a man to fish or give a man to fish. And as I say, well, why not do both? That is the abundance mindset after all. At GetRichEducation.com, we teach you how to fish. At GREturnkey.com, we give you a fish too. And what is going on at GRE Turnkey? Well, first, get your mortgage pre-approval at a reputable lender that specializes in investment property like Ridge Lending Group. You'll see at GREturnkey.com that Birmingham and Huntsville, Alabama have investor advantage numbers that work. Pockets of Huntsville may have better appreciation if they're tied to employment in the space industry. Gosh, love him or hate him, Elon Musk gave us something to actually celebrate in an otherwise tough 2020 as he led the first private company to launch astronauts to space. That is emblematic of the burgeoning space industry. In both Huntsville, Alabama and Orlando, Florida, there at GRE Turnkey pick up on some of that industry. We just discussed Chicago here last week. Both Chicago and Dayton, Ohio, they're two markets that keep sourcing existing inventory that they beautifully renovate and tenant and keep under management for you. And both of these markets have rent-to-price ratios that are typically over 1% on their properties. When you're over 1% and mortgage interest rates are this low, it makes your affordability as an investor really advantageous. So that's Chicago and Dayton. Des Moines, Iowa is sourcing a little inventory lately, not as much as some of the other providers. Des Moines is a stable place. Florida is a bright spot for new construction turnkey property. Jacksonville, Tampa, and the aforementioned Orlando are all sourcing brand new construction property. And when it's new construction, your insurance cost is often really low as well. Memphis, Tennessee, and Little Rock, Arkansas are both the same provider there at GRE Turnkey, and that provider name is Mid-South Homebuyers, by the way. And there you have lower price points, and Mid-South Homebuyers is just so good with beginners. And then Oklahoma City. The numbers work. The price points are really low in Oklahoma City as well. You often get $850 rent on an $85K property. And some media outlets have named Oklahoma City as the most recession-resistant market in all of America. And then finally, Richmond, Virginia. I mentioned them earlier. They specialize in knowing the ways and means of how to optimize Section 8 tenancies because they have a great relationship with the housing authority there. Most or really all of these markets that I mentioned are in the United States, Midwest, and South. Florida, oddly enough, is not culturally the South, though it is the most southeastern state that there is. But Florida's history of net in-migration makes them culturally disparate from what we think of as the South. But all these markets I mentioned are in investor advantage metros where you generally have more stable prices and landlord-tenant law that favors your rights more so than the tenant's rights. A lot of affordable properties there. Some of the more expensive ones might be those new construction properties in the Florida markets where they cost maybe $200K to $250K. Properties that cash flow, single-family homes anyway, rarely cost more than something like $250K. So these markets are hand-chosen pretty carefully for you. Once you're pre-qualified for a loan, find all those providers and a few more at GREturnkey.com. and get started. I am honored because you have given me something again, and that is that I have had the privilege of having your time today. Until next week, I'm your host, Keith Weinhold. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.